Hello and welcome to the Calamos Market Neutral Income Fund presentation. My name is Tim Brand. I'm the head of intermediary distribution at Calamos Investments, and I'm joined by Scott Henderson, Senior Vice President and Chartered Financial Analyst and Portfolio Specialist. The purpose of this presentation is to educate our audience on the Market Neutral Income Fund and to discuss how the fund will perform in different market environments. So we'd like to start by giving some background and an overview of Calamos Investments for those of you who aren't as familiar with us, and then discuss the investment team structure. I'll then introduce Scott to talk about the investment opportunity and process, and then go through the product profile, and then some frequently asked questions after that. Calamos Investments was founded in 1977. We have just under $22 billion in assets under management as of the end of the first quarter of 2018. We're headquartered in the Chicago metro area with offices also in New York, San Francisco, and London. We have 40 years of global asset management, and we're focused on risk-adjusted alpha. Importantly, we have over $6 billion of alternative strategy assets, again, as of March 31st of 2018. If you look at the history of our firm, we have a strong tradition in alternative investing. In 1990, we launched one of the first liquid alternative funds that was available for mutual fund investors. In 2012, the Calamos Market Neutral Income Fund management team was nominated for U.S. Morningstar Alternative Funds Manager of the Year. In 2014, we launched the Calamos Hedged Equity Income Fund. And then in 2015, we acquired Phineas Partners and launched the Calamos Phineas Long Short Fund. So if you look at the timeline, the history of our firm, we were founded in 1977 by John Calamos Sr. We launched the Market Neutral Income Fund in 1990. We launched the Calamos Phineas Long Short Fund in 2015, leading to over 40 years of global asset management. We have an investment professional team of 70 employees, and they're led by 6 global CIOs that average 30 years of experience. The team that runs the Calamos Market Neutral Income Fund is led by John Calamos Sr., Eli Pars, Jason Hill, and David O'Donohue. And you can go to the Market Neutral Income Fund homepage at calamos.com for more detail on the team and their experience. At this point, I'd like to introduce Scott Henderson to talk about the investment opportunity and the process.
Well, thank you, Tim, and welcome to the presentation, everyone. I think one of the things that's always been interesting about the markets has been volatility, and we've always talked about the flip side of volatility being opportunity. And if we look at what's happened to the markets since 2008, a little over a decade ago, we all remember what that environment was like. The trend has really been overall, at least through 2017, much higher volatility in the markets, and probably more importantly, much bigger swings in both upside returns and downside returns, as you can see on this chart. Since 2008, we've had more returns that have been higher than 4% per week, both to the upside and the downside. So we've definitely seen more volatility in that period. Additionally, alternative investments have been sought by investors as perhaps a way of smoothing out the very volatile ride. When we talk about market neutral income, when people ask me what I do for a living, I try to break it down to 2 words: monetize volatility. So the trend in volatility and the fact that we've had these 5% or more swings in the market provide great opportunities for a product like market neutral income to seize on the volatility and monetize, and we'll talk about that further in the presentation today. So let me begin with a brief overview of what we're trying to achieve with the fund. The Market Neutral Income Fund we think of as an alternative fund that really is there to provide absolute returns. We utilize 2 complementary strategies, convertible arbitrage and covered call writing, to achieve those objectives. So 3 things we're really trying to achieve are absolute return, historically lower equity beta and volatility, also with limited drawdowns relative to the market, and also providing income and capital appreciation while also providing a preservation of capital. We started this fund back in 1990, so it's one of the oldest liquid alternative mutual funds. One of the things I always say is that we were liquid alts before liquid alts were cool. And really, I think we've seen more and more interest, especially in an environment where we've been seeing very low interest rates. We've seen a pickup in volatility. I think more and more investors have been looking for strategies like these. So as I drill through the strategies, we'll talk about the fact that we have the two complementary strategies, the convertible arbitrage and covered call writing. The picture I always like to paint is a proverbial seesaw that you grew up playing with on the playground. We'll put convertible arbitrage on one side of the seesaw, covered call writing on the other, and you can think of volatility as kind of being that fulcrum point in the middle. The idea is that these strategies complement each other extremely well. Convertible arbitrage, I would describe, both of these strategies, by the way, will work well in a variety of different market environments, but convertible arbitrage I would describe as more of a long volatility strategy. As volatility is increasing, it's going to create a lot of opportunities for us to rebalance our convertible hedging. Covered call writing, on the other hand, is more of what we call a short volatility strategy. When you sell a call option and volatility falls, the probability of getting to a strike price, and we'll get into this more detail in the presentation, is actually declining, and it makes the value of the option fall. So you're profiting when you sell that call option in that environment. So having those two strategies, let me drill down on each of these strategies individually, and we'll start with convertible arbitrage. The convertible arbitrage strategy starts by a long convertible bond position. A convertible bond is a bond that has the right to exchange the bond for the underlying stock, hence called a convertible. You can convert the bond into the underlying stock. What we're trying to take advantage with convertibles is the idea that because you have that right to own the stock, as the stock price is going up, the convertible is gaining more and more equity sensitivity as that option to convert into the stock is getting closer to and above the conversion price that the convertible converts into. On the way down, however, the convertible bond has a bond component. Like any other bond, the bond will mature at par, essentially creating a put at par for the bondholder, and underneath the convertible. So as the stock price is going down, the convertible is actually shedding some of that equity sensitivity. So the idea is we're trying to take advantage of that asymmetric upside-downside relationship. So you can see as the stock price goes up, this slide, by the way, we're looking at is the stock price on the bottom relative to the bond price on the vertical axis. You can see that the convertible really has two functions. One is the value that the convertible would be worth if it converts into the underlying stock. That's labeled as the diagonal line here, called conversion value. The other value we have is called the bond value, the investment value. That's the value of the convertible if we just set that conversion option aside. So you can see what's happening is as the stock price goes up, the convertible is tracking closer and closer with the underlying stock that it converts into. But when the stock price goes down, the bond value acts there to hold the price up. So the idea that you have this asymmetric upside-downside profile with the convertible relative to the common stock that it converts into is what we're trying to take advantage of in the relationship here. Talk about four opportunities that convertible arbitrage will provide. One, of course, is that we can receive the coupons on the convertibles in the portfolio. So convertibles, like any other bond, pay coupon payments. Right now, as I'm recording this presentation, you're looking at convertibles in a range of about 2 to 2.5% current yield. The fund does not utilize leverage, and what that means is that when we short the underlying stock and receive the cash proceeds, we're not taking that cash and buying more convertibles and levering it up and up the strategy. The cash actually stays with our custodian, and the arrangement that we have with the custodian is that they will rebate to us any overnight interest that is earned by that cash. And that's netted out, of course, against the borrowing cost of the underlying common stock. With a Fed funds rate, again, as the day of the presentation, of around 1.75%, and an average cost of borrowing stock at roughly 0.42%, we actually have a positive carry there, and that positive carry is another source of return for the fund. Additionally, there are two active ways that we will try to add value. One is by the understanding that we're trying to find convertibles that are trading at discounts to their fair theoretical value. So it's called capital appreciation from buying an undervalued security. And while we're doing everything else that I'm about to describe, we hope to have some appreciation as the convertible trends closer to its fair value. But not least would be that rebalancing trading. And then I'll go have a convertible bond, comes out at $1,000 face value, and it's convertible into 100 shares of common stock. The first step in looking at the convertible, of course, is to look at the credit value and making sure that we're going to get our coupon payments. It's not so much that we're necessarily worried about defaults, common stock price we're going to short, so we have a natural hedge being short the stock, but we want that bond value to be able to hold up the value of the convertible. So the bottom line is we tend to look for convertibles that have relatively stronger balance sheets, and while we're not necessarily averse to the lower end of the credit spectrum, the lower end of the credit spectrum generally don't have the parameters that we're looking for in terms of the bond value holding up. From there, what we're going to do is we're going to measure the equity sensitivity that the convertible has to the common stock that it converts into. So let's say today that for a 1% move up or down, that convertible will change by 0.65%. We'd have 65% of the capture, if you will, of the underlying stock that the convertible converts into. So to neutralize that equity sensitivity for that small event, we're going to short 65 of those 100 shares to create an equity neutral hedge. From here, what we're hoping happens, obviously, is the stock price either moves up more than that 1% or moves down more than that 1%. Because, again, what's going to happen is the convertible either gains equity sensitivity on the upside or sheds equity sensitivity on the downside. So let's just say, for example, that the stock price declines by 5%. What are we going to do now? We're going to remeasure that equity sensitivity for the next small 1% move. And maybe now for the next 1% move, the convertible will change by 0.6% versus that 1% common stock move. So we have 60% of the equity sensitivity now. Well, remember, we started by being short 65 shares to establish the neutral hedge, but as the stock price declined, we only have 60% of the equity sensitivity. So now we only need to have 60 shares short to be equity neutral. So what do? We buy 5 of those shares back, essentially cover 5 of those shares that we were short, lock in a small trading profit. If the stock price then moves back up, we can step in and short stock again. If the stock price comes back down, we can step in and cover. So more volatility, up and down volatility, is going to create more and more of those trade rebalance opportunities that we can use to tack on to the other sources of return. Switching gears now, we'll talk a bit about the covered call writing strategy. And the covered call writing strategy involves several different parts. The first part would be to construct a long stock portfolio that for most practical purposes you can think of as an S&P 500 tracking portfolio. We currently own roughly 260 S&P 500 stocks that are optimized to perform with a very low tracking error to the S&P 500. Now the reason that's important is because what we're going to then do is write S&P 500 index calls and buy S&P 500 index puts against that equity basket. Calls generally are written 3 to 5% or so out of the money, and we're trying to take advantage of the idea that the longer you allow that option to exist, the more premium you'll collect. That's called time value premium. So more time in an option means that there's an opportunity to collect more premium. On the protective put side, we also want to buy those protective puts roughly 3 to 5% out of the money, but we're going to generally use shorter dated puts. The idea being that if you have less time value, those puts in general should be less expensive. So the sources of return that you generally would expect to receive from covered call writing would be equity upside participation up to where we have written our calls, and I'll discuss this in more detail in the upcoming slides. The dividends on the long equity positions. We hope over time that we will somewhere in an expected range of about a 2% net premium capture. And then again, we're not setting and forgetting this portfolio. As the market goes up and down, we're going to rebalance our option hedges and try to deliver some returns that way. So to talk about covered call writing with protective put buying, we've actually included some payoff diagrams here to help better explain what we're trying to accomplish with this strategy. So again, just like convertible arbitrage, I'll start with a hypothetical illustration. Let's suppose that an investor, buys a stock for $50. You can see in the diagram all the way to the left here, if the stock price goes up, we're appreciating directly with the stock that we own. But of course, if the stock goes down, we also have all the downside that's inherent with the common stock. What we can now do is essentially sell a call against that stock, and the idea is that we're going to try to exchange upside participation for a more consistent income stream. So you can see in the second payoff diagram, this would be what would happen is if we sell a call. In this case, we're going to sell a call with a strike price at $55. The idea here is that if the price stays at $55 and doesn't move higher, we're going to collect $3 in premium. As the stock price goes up, and especially as it starts to exceed $55, though, you're losing on that upside on the covered call. So when I bring the two pieces together, the equity and the call option that we wrote, we end up with the diagram all the way to the right, the covered call payoff. And you can see what's happening here is that we established the position at 50. We're going to participate on some of the upside to the point where at 55 we're capped out. But remember, we received that $3 in premium that we still get to keep as the stock price goes up. On the downside, the idea here is that the premium also provides a bit of downside protection. So we actually would break even here in this example at $47. So just to summarize, what we've done is we've traded upside for a more consistent income stream. And the dashed line here is what we normally do in our market neutral income would be in our guidepost type of strategy, write 80% calls against that equity basket. So you can see we're going to participate some to the upside with some downside protection from the standpoint that we received the premium on that call that we wrote. But clearly, if I did nothing more, you can see, we have downside here, and we're trying to be an absolute strategy and protect on the downside. So we need to add another step, and that's here on the next slide, where we're going to add what's known as a protective put to the strategy. So we start again with that covered call payoff, where we're going to capture upside capped at the upside strike with downside. If we then add a protective put, we'll buy this put using this example at $45. It's going to cost us about $2 in premium to buy that put protection. The idea now is if the stock price falls down to $45, the put by itself, will kick in at value at 45, so it protects against any further loss below 45. If I then add that put to the covered call piece that we have, we end up with the diagram on the right, the covered call with the put. And in this case, if the stock price falls below that put strike price of $45, we only lose the difference in the stock purchase price and the put strike price, right? And minus the put premium. But we also get to keep the $3 premium. So we look at the downside. You have the $50 starting value. $45 is obviously where the put stock price is. Subtracting the $2 that we paid in the put, adding the $3 back that we received in the call, still means that we're only down $4, and we have some downside protection there with that piece. So the idea here, what I've just described to you, is what they call a collar strategy. We're going to essentially forego the upside beyond the first 10% move, forego the downside beyond the 10% move, and exchange for a net positive premium that we're capturing with the call. The dashed line here that you see kind of describes the strategy that we're generally trying to use in the market neutral income fund, which is that while we generally write 80% or so in calls, we're also buying 40% or so in puts. So the idea is that we're trying to create an attractive upside, downside participation rate relative to the S&P 500. So we're essentially creating a opportunity to participate in the upside with less downside. So just kind of to refresh on what we're trying to do with covered call writing, the process we're doing there, we start with that long portfolio, a portfolio of equities that has a high correlation to the S&P 500. We use optimization to help us get that low tracking error. At the margin as well, we can look at the equities that we're investing in. If we see one stock, say Pepsi, looks very inexpensive relative to Coke, We might be able to put Pepsi in the portfolio at a 1.1 times weight and Coke as a 0.9 times weight. We're still equal to the index in terms of the consumer beverage industry, but the idea is at the margin, maybe perhaps we can add a smidgen amount of alpha relative to the S&P. Can't get too crazy because, again, our objective here is to keep the volatility low and maintain a very low tracking here to the S&P, but there is a potential opportunity to add incremental value through the stock weighting process. We'll then write some calls against the equity basket, roughly 80% in calls, and then buy some protective puts. And then the idea is the market goes up and down, we're going to restrike those options to basically, when the market pulls back and the puts get into the money, we have profit on the puts that we own. We can take some of that proceeds and add that back to our call piece. When the market then moves back up, we have profits on our calls. We can take profits off the table on the calls, add that more back to the put idea, and the idea is that we're clipping a little bit of return. So hopefully I've described both of these strategies well for you. Let me just kind of finish up here with a summary. The fund itself was launched back in 1990 as one of the first alternative mutual funds and really does capitalize on our experience in the convertible space going back more than 4 decades. John Calamos, back in the early 70s, was selling warrants against convertibles. So this is a strategy that's been around for over 4 decades and, again, started over almost 30 years ago now in the mutual fund format. The other side of this is that this is a 40 Act fund, has a daily NAV. We provide full transparency, fund governance, liquidity, and relative to traditional hedge fund formats as well, this fund is very low and very competitive fees. The portfolio team that we have managing the fund has 65 years of combined industry experience, including over 25 years here at Calamos. And the idea is by using these complementary strategies with covered call writing with protective puts and convertible arbitrage, we can hopefully capitalize on the volatility provided by the market to generate income over time and provide a risk-managed solution over the full market cycle. Over the history, I think our approach has demonstrated lower correlations, especially to fixed income benchmarks, which obviously should help the overall allocation. I think we'll talk about that upcoming here in a current Q&A. And obviously, again, our focus is on risk management as a primary focus. Our idea is to keep our beta below what they call 0.3, 30% equity sensitivity relative to the S&P 500, while always striving to provide that absolute return. So with that, Tim, I think it'd be a great opportunity to start taking some questions here.
Yeah, thank you, Scott. I'd like to conclude our presentation with a few frequently asked questions. And the first is, how does the fund fit in an asset allocation?
Well, thanks for that question, Tim. I think when you look at the world through a lens of a traditional 60% equity, 40% fixed income, the question I often ask is, what's the 40% fixed income there for? In today's market, is it really about the very generous yield that you're receiving on that side of it? I would argue, of course, that's not the case. The idea is that 40% fixed income is generally thought of as the safe place for us to allocate with our portfolios and afford us the opportunity to take risks somewhere else, whether it be equities in that 60% or other more volatile investments. So the challenge I think we have today in the lower interest rate environment with the Federal Reserve that is ending their quantitative easing activities and, as mentioned earlier, is raising interest rates, is that there's a lot of risk perhaps in the bond market as a whole. Obviously, it's a market of bonds, not just a bond market, so there probably are some good, attractive bond opportunities. But the same token, we feel that market neutral income best fits the allocation at present on the fixed income side. So if you take a portion of your fixed income assets, one of the most important concepts here is that interest rates are moving higher. This fund does not have the sensitivities to those rising interest rates.
Great. That leads to the second frequently asked question, which is, how has the fund done historically when interest rates do rise?
Yeah, another great question. I think the bottom line is when you look at the last 20 years, anytime we've seen the U.S. 10-year Treasury move up by 1% or more in yield, bonds have been down, our fund has been up over those times. So we don't have the interest rate or duration, as they call it, sensitivities, the bond-like sensitivities, but we don't have the opportunity as well. So if interest rates continue to move higher going forward, and volatility persists in the market as we expect it will, we think this is a great opportunity for the market neutral income fund going forward.
Scott, thank you very much, and thank you to our audience for joining us for this presentation. I will direct you to calamos.com and specifically the Market Neutral Income Fund homepage for further information about the fund and more timely materials in terms of recent performance. You can also call Calamos at 1-800-582-6959 for further questions as well. Thank you again for joining us, and have a great day.
Okay.
All right.